Welcome to Module 4. Module 4 is a topic on investing, money, wealth building, and everything that revolves around money, financial systems. This is a good topic, so because it directly affects us. So let's get started. We will. What shall we look at this topic? We'll explore how money grows, how financial markets operate, and how individuals create wealth over time. We learn about stocks, we learn about bonds, the power of compound interest, compounding. We shall look at how to manage risks and rewards, and how the Federal Reserve shapes the economy that we live in. So by the end of this lesson, you'll have the tools to start thinking like an investor, to build wealth by making one decision at a time. So this is essentially about money, multiplying money, and making sure that the money that you multiplied, capital preservation and capital protection. So the topics will be as follows: introduction to stocks, bonds, and mutual funds, the power of compound interest, compounding, creating a business plan, the role of the Federal Reserve and the US financial institutions. Then we shall look at how do you build long-term wealth once you have the money. Let's start by looking at why investing matters. So saving is good because saving is for tomorrow. Investing is for the later date because saving alone will not outpace inflation. We invest when investing, there's what we call inflation, and inflation always eats away our money. So it's paramount for us to save, and while saving, save at an interest, invest at an interest value that is slightly higher than the inflation rate, so that when inflation eats away a portion for money, we shall still have some money left. So investing will help you to grow money faster than inflation. It helps us to build financial freedom and help us to convert the earned income that we earn physically when working into passive income. Every small amount that you invest today or tomorrow early and consistently will become a significant amount over time because of the compound interest. Don't work for money, let money work for you, make money work for you. This is a principle of the rich. Let's start by looking at stocks, bonds, and mutual funds. So investing means using your money to buy assets that will generate income and increase in value over a long period of time. So the most common investment vehicles, investment types are stocks. And stocks represent ownership in a company. When the company grows, your investment grows. Look, I have an illustration here. You're buying stocks of a particular company, and so you buy stocks of company A, then you buy stocks of company B, you buy stocks of company C, you buy stocks of company D, you buy stocks, and you buy stocks. After a period of time, this becomes your portfolio that you bought from different companies. When the value of this increases, it becomes more. So it's no longer one like it is now, but it becomes more to something like maybe potentially this, or something like potentially this, so that it becomes a bigger value than what you initially bought. That is stocks. Now, what are bonds? Bonds are loans that you give to the government or corporations. Anytime a bank or a corporation or the government wants to raise money, it invites the citizens to to invest. And so these are bonds, and they are loans, and they are normally repaid at an interest. What are mutual funds? Mutual funds are pools of money from many investors who come together to buy a mix of stocks and of bonds. This helps with diversification. Now, think of stocks like ownership, you are owning something. Then think of bonds like you are lending money to someone. then think of mutual funds like teamwork. We come together and we put our different money together so that we now with this money we're able to buy something big. Look at potentially a building like this one, or we want to buy a bigger business like Amazon. So we come together, invest money, and then it becomes a mutual fund so that we're able to do something big. How does an investment grow? Anytime we invest, investment will grow through three main mechanisms: either capital gain, the value of assets increasing, dividends or interest, and as well as reinvestment. So you get your money, but instead of taking it back, you plow to taking it to, to, to as profit, you plow it back so that it earns more interest. The stock market. Have you ever gone to the market to buy something and you find people are selling tomatoes, others are selling onions, others are selling uh, vegetables? So the stock market is also a place where investors buy and sell ownership in public companies. But now this is done virtually. It's not a physical thing. Now, in the US, the two biggest markets are the New York Stock Exchange and the Nasdaq. I mentioned this, but if you buy a share of Apple company, you become a partial owner. If you buy a share of Amazon, you become a partial owner. So if Apple earns profit and innovates successfully, the amount of share that you bought also increases in value. So if you bought a share at $30, for example, it when it becomes 35, then you have a margin of 5. The stock market mirrors confidence, innovation, and health of the overall economy. So that is it about stocks. The power of compound interest. Compound interest is referred to as the eighth wonder of the world, and it means that you earn interest on the interest that you've already earned. The longer your money stays invested, the faster it grows because each year you you earn profit, you earn interest, but then now that interest is plowed back. So that next time you earn interest, you are earning interest on the principal and also on the interest that you earn. This is how compound interest works. This, as you're able to follow from this diagram. So if you start year one um, with a starting balance of $1,000, when the interest is 8%, so your interest at the end of the year will be $80. So that at the closing of that year, you have got 80, the interest, plus the 1,000, so that you have 1080. So that continues like that. So when you go to the second year, your starting balance is no longer 1,000, but now it becomes 1080, and that accrues all over the tenure or the period that you'll be investing. So you realize that by the end of 20 years, 30 years, you started with a very small amount, but your money has grown significantly. When investing, it's important for us to understand what we call risks and reward. Every investment that you make, whether in bonds, in bills, in ETFs, in any other fund, any investment has got a level of risk. And any person who tells you that you are investing but there are no risks is lying to you. So the possibility of losing money is just the same as the possibility of gaining money, only that now through research, you realize that chances of you making money are high. These are the common risks: the market risk, inflation risk, and liquidity risk. You can sell quickly when you need cash. So, successful investors don't fear the risks, but they have mechanisms and structures that enable them to manage risks and manage them well. So, that it's important for you to balance risks and returns. So, normally, low risk, low return; moderate risk, moderate or steady return; high risk, high potential return. And we have got also those examples. So the goal is not to avoid risk, but to balance it with your goals, your timelines, and the comfort level. Like how much money are you? What is your risk resistance? How easy are you? Comfortable are you to lose a particular amount of money? Now that we've looked at risk, let's look at diversification. Diversification means spreading your investment across different asset classes or across different types so that poor performance in one area does not affect your entire portfolio, your entire investment amount. In simple terms, don't put all your eggs in one bucket so that now you can combine. You can do stocks, you do bonds, you do savings, you do mutual funds, you do those ones so that you diversify. And diversification will always be your best defense against volatility and market uncertainty. The main functions of investing are diversification are you control inflation by adjusting interest rates, it encourages employment and steady growth, you regulate banks and keep financial systems secure, and influences borrowing and spending through policy decisions. Sorry, we had talked about diversification. So what I was talking about, these are the functions of the Fed, the role of Federal Reserve. So just a recap. The reserve, normally known as the Fed, the central bank of the United States. It manages the nation's money supply, and at the same time sets the rates to promote stability. So these were the functions of the Federal Reserve: control inflation by adjusting interest rates. It encourages employment and steady growth, regulates banks and keep financial systems secure, and influences borrowing and spending through appropriate policy decisions and regulation. There's a time that the Fed raises the rates. When it raises the rates, borrowing becomes more expensive, and people and business will spend less. This will help the economy to slow down the inflation. Financial. Let's look at financial institutions and the market. Financial institutions, these are essentially a network of organizations that keep money flowing consistently. And the key players are commercial banks, investment banks, credit unions, and insurance companies. So a combination of all this ensures they keep the economy moving and to maintain just confidence in the marketplace. Now that we've looked at the Federal Reserve, let's quickly look at wealth, building wealth. Building wealth is not a one-time thing; it's an ongoing process. So follow these five core principles when you're building wealth. Start early. When you're building wealth, it's paramount for you to start early. To start early means that time will be your greatest ally, your greatest friend. Save consistently, invest wisely, avoid bad debt, then reinvest the earnings so that you're able to accelerate growth over a long period of time. So let's look at retirement planning. Anytime you start a job, you start working, it's always important for you to think about retirement because at the end of the day, it will still come. So retirement may feel far away, but the earlier you start, the easier it gets. And there are plans like the 401k and the individual plans like IRA. These plans will let you save money on taxes while your money still grows. It's important for you to be consistent and when saving this money so that the money can compound the interest and will enable you to build a buffer, a financial freedom or buffer when the time comes for you to retire. And remember that always pay yourself first. This paying yourself first involves investing this money in a retirement planning scheme. Another key concept that we have to look at is the passive income. There are two kinds of income. We have got active income and we have got passive income. Active income is the money that you work for it actively, like you have to wake up in the morning every day and go to work. But passive income is money that you earn with minimal ongoing effort. I've not said that there's no effort. There is effort at the beginning, but this effort, as time goes by, this effort becomes minimal because you've already had the initial setup. Basic examples, major examples are dividends. When you buy stocks, dividends from stocks, rental income, real estate, royalties from creative work like writing books, creating courses, and or online businesses. True financial independence happens when your passive income is greater than your expenses. That's when your money is really working for you. These are some of the common investment mistakes that we are supposed to be aware of. So avoid these mistakes. Investing without research, chasing get rich quick schemes, letting emotions like fear or greed or fear of missing out control your decisions, ignoring fees and taxes and other costs, and then losing patience and withdrawing too early when the time has not yet come. So, an activity for you, start an investment plan. This is imagination. Suppose you have $10,000 and you want to invest this money in a virtual stock market game. The work is you do a research in a number of companies, 5 or 10, or funds, then decide how to allocate your money and track your results for a period of 1 month. Record gains, record losses, analyze your diversification, and explain the lessons that you have learned. So, as we summarize, this is what we have learned, that you've learned to understand and apply the principles of investing. You're able now to identify different investment types. You're able to use compound interest to build wealth. You are able to balance risks and reward and see how the Federal Reserve and financial institutions shape our economy. Most importantly, you've understood that wealth is a long-term journey. It's a long-term game that is built for a long period of time through consistency, discipline, and smart decision making. So the question is, if you had $10,000 to invest today, how are you going to grow that money over the next 10, 20, 30 years so that it gives you more returns? So how will you invest that money? How will you grow that money? Research on potential on possible investment vehicles and share with us your feedback. So that is it for module 4. I'll see you in the last module. Bye bye for now.